Hello, everybody, and welcome to the Nasdaq Dorsey Wright podcast for this week being May the 10th, 2021. My name is Jay Gragnani, and here joining us this week is Chuck Fuller. Chuck, great to have you on.
Yeah, great to be here. It's been a little while. I'm looking forward to talking.
You know, it's interesting this time of year, as we discussed last week on the podcast, with the month of May coming in, so brings what is historically known as the seasonally weak 6-month period in the market. And that's a period of time that has engendered an adage in the market that is called sell in May and go away. And we dove into a lot of those numbers in last week's podcast. So if you missed that on market seasonality, be sure to go back and listen to that. And while we've seen a bulk of the return come in the market during the seasonally strong period, that being from November through the end of April, it doesn't necessarily mean that this next 6 months in the market has to be a weak stretch by any means. As a matter of fact, recent data shows that there's actually a fair number, 9 out of the past 12 seasonally weak periods of the market have actually produced positive returns. So with that said, though, we wanted to focus a little bit more on some interesting activity that we've seen within the markets, not only here recently, but also historically as it relates to some data points that we've seen. And one of those data points that we've seen is just a sheer number of new stocks rising and hitting new 52-week highs. And that in and of itself, it probably isn't all of that surprising or shocking, just given what the market has done really over the course of the past 12 months or so since the market bottomed in March of 2020. But here over the course of the past couple of days, we've seen a lot and a historically high number of individual stocks, Chuck, moving to new highs here recently.
Yeah, we really have. So, if we look at Friday's action, of course, we went to new highs on the S&P, that day. And we saw, I think it was 552 new highs on the NYSE that day. And that's historically pretty high. I mean, if you look back at time, I think maybe there's been like 15, 16, different days where you've seen new highs that high. And typically, you might say, kind of sounds like a bad thing. Maybe it's getting overstretched. And that could be the case over the short term. But in general, it's happened in pretty good market periods. If you look back. So, it happened in kind of the beginning of 2010, which is kind of sort of similar to now, right? You had a big bounce off the 2009 bottom, and you're about a year out from that bounce. Once you kind of in the March, April 2010 period. It also happened off the 2003 bottom after the tech crash, at the beginning of that decade. So you kind of saw that kind of late 2003, 2004, and then maybe like 97 and then 1982 were the other times we've seen it, going back all the way back to 1979. It's very rare. And actually today we're seeing, even more new highs. I'm looking out at the Wall Street Journal page right now, and I'm showing 633 new highs, which is even more historic. Actually, if I look at the data, I'm just going to update my thing. Yeah, this would be the fourth highest new high day that we've seen since 1979, which is just wild. Especially considering what we're seeing today. I mean, this isn't like some runaway bull market day. We're seeing the Nasdaq down 1.5%. We're seeing, I'm looking at the Russell's down, about 0.9%. The Dow's doing great. It's up 300. So it's a very strange day in the market today. Seems to be, we're seeing a continuation of this kind of value trade that we've seen the last few months. You've seen, we were talking about that a little bit before the call, JG. I was looking at VLUE and it's, somewhat flat, but you were looking at another ETF that seems to be doing quite a bit better on that front, right?
Yeah, I mean, the value thing. So RPV is a Invesco S&P 500 Pure Value ETF. RPV is the ticker symbol on that. So that's really like your large cap value. And even the iShare Russell 1000 value ETFs, those were up around 60 to 80 basis points each so far today versus growth RPG, which is a S&P 500 pure growth ETF, was down about 1.3%. So, even just today, while it's interesting, you continue to see that value trade really play out this year, and it's even going further today with a lot of the more value-oriented areas of the market performing well. Not the least of which being energy, which has done well so far this year, and continues to be the best performing sector this year, which is a very interesting thing to say given what's happened with energy over the past few years. Energy has really been the big laggard area, doing well this year, and it's coming on the heels of Friday, the news coming out of the Colonial Pipeline having to shut down. And that is certainly a big deal. Cyber attack causing that, but that has certainly been a big deal. But really, it's not energy. While energy is continuing to lead, really today you're getting movement and getting positive action out of a lot of the value-oriented or more defensive type of sectors. I mean, just today, if you look at all of those sectors, you look at utilities, real estate, industrials, financials, staples, as well as energy, all up right about 1% so far today versus some of the more growth-oriented sectors, technology, communication services, by and large, as well as consumer discretionary, those are all down 1% or slightly more. So you're really seeing a big spread there today in this value versus growth phenomenon that's really been playing out for quite some time.
Yeah, I mean, it's interesting too. We were talking about, again, a little bit before the call, but, you heard about the hack and you kind of expect, gasoline futures or, crude futures to really go up over something like that. But we haven't seen it. Gasoline futures have turned down, crude oil futures have turned down. It's really kind of interesting, but, the stocks themselves are having a good day. And actually, I was just looking at the chart of XLE, which is, that Spider energy ETF, and it broke out today. Again, took out its March high. And I was looking at a longer term chart of it, the 2%, or not the 2% chart, but the $2 chart, and it's actually right up against its trend line. So it's like its longer term, bearish resistance line or its negative trend line. It's right up against it. So I think that's going to be interesting to watch, going forward. If it makes it through that, it'll give a little bit more credence towards this idea that energy's, on its way back.
Yeah, it certainly has. I mean, it's been, like I said, it's been the best performing sector so far this year, and it's done so while crude oil prices have continued to climb. But really, you look across the board, and while crude oil and energy commodities in and of itself, they tend to be the largest weight inside of any commodity related indexes or commodity, right, broad-based commodity funds, just because they tend to be more production weighted. So very similar to how the S&P 500 is cap weighted, the biggest companies are getting the biggest weight. Some of the bigger well-known commodity indexes just put more weight towards the commodities that have more production, crude and energy being right at the top of that list. But the strength within commodities really has been seen across the board. There's been a lot of pockets, a lot of positive areas within the commodity space outside of energy, with some of the agricultures and base metals as well, copper, being right up there at the top of that list, and things that are doing well. So, within the commodities, it has been a very, very interesting movement in crude oil, and the energy pipeline obviously is going to grab all of the headlines. But, just looking underneath the surface, you've seen a lot of strength within commodities.
Yeah, no doubt about it. It's interesting that you bring up the the commodity index weighting too, because it's kind of the opposite, right, with equities, where energy has a low weighting right, in the S&P, let's say, mostly because it hadn't done very well, right, over the last little while. So, again, it's going to be interesting to see how that does going forward.
Yeah, I mean, energy is one of the least important sectors to the S&P 500 in terms of its weighting, around about 3% of the S&P 500, versus technology, which is now closer to about 24% of the S&P 500. So, the fact that energy is doing well is certainly good for energy stocks, but not necessarily a big driver of overall market performance in terms of the S&P 500, which when we look at the markets and have the ability to rotate towards that strength, a strong move in energy could certainly benefit those that are utilizing a relative strength-based approach at navigating the markets, because they have the ability to get into an overweight areas like energy, like maybe basic materials, some of these sectors that don't tend to be big weightings within the S&P 500, but over time have the ability to drive big returns within a portfolio. So, that is certainly something. We look at energy. It's been among the stronger sectors within our Dolly rankings for quite some time now, and continues to be up there within the top half of the sector rank. So, energy continues, and really a lot of the commodity related sectors continue to show good positive relative strength within the market. I think one of the big questions outside of what's happening with the markets and just the interesting activity today, one of the big questions that we get a lot, or certainly on a lot of people's minds as we're sitting here at new highs and a lot of stocks continuing to push to new highs, is when's the next correction or the next market pullback around the corner? And there is this data that we've looked at over the years that just looks at, a 10% pullback in the market is something that we would talk about as being a rather normal pullback that has been seen in the market on average about once a year. And I emphasize the on average piece of that, because there's more once you peel back the covers there, that when you dig into the data, it's pretty interesting. But this idea that we get a 10% pullback per year, and we're over a year now since we've had a 10% pullback. You have to go back, since the market bottomed in March of 2020, we had the market, as defined by the S&P 500, has not seen a 10% pullback. There have been other pockets of areas that have pulled back 10%, but we're just talking about the S&P 500 here. Has not pulled back 10%. So, Chuck, when we look at that, that data point, should we just expect every calendar year to see 10% pullback and be done with that?
No, you shouldn't. It's one of those things that like you said, you tend to see one a year. But when you look back in time, and we've got S&P data going back to 1927, and there's a lot more in obviously bad market periods, and there are good market periods. So if you go back to the the 1930s, there are a ton of 10% pullbacks. In the 1930s, obviously there was a Great Depression during that period. Even in the the beginning or the first decade of this century, the 2000s, we saw quite a few too. Nowhere near as many as the 30s, but still a fair number. But when you get into bull market periods, you tend to see fewer. And yeah, there's definitely times where you go long periods of time without seeing a 10% pullback. I think the most recent kind of multi-year period that we saw was kind of this between 2011 and 2015. You basically, if you remember, I just remember 2012, 2013, and 2014 were like pretty easy years for the market. You saw some pullbacks, but nothing substantial. The market more or less just kind of went from the bottom left corner to the top right corner. And then but everybody thinks about like the 90s too as being like an incredible time to be invested in. When we looked at that period, it was pretty similar, right? You had basically a 7-year period where you never saw a 10% correction from like 1990 to 1997. Right after that, you saw, 20% correction in 98. And, obviously things started to top from then on out. But yeah, for sure, you can go a long period of time without seeing one. So just, we're, a little over a year out from the last one that we've seen. And I think a lot of people, that causes them to hesitate and say, oh, we must be, at or near a top. And that could be true. You never know, with these things, it's somewhat random. But just looking at that by itself really doesn't tell you that we're going to see something over the short term, because it could very well just keep on running. And really, that's what people least expect. I feel right now, we're coming off the Corona crash, and I feel like the psychology that's going on in the market is everybody's expecting there to be another big crash. Maybe not Corona style, but once you get a 35% crash, you kind of expect the next one to be, pretty big too. I kind of remember this after 2008. Everybody was expecting the next 2008 to happen in 2010 or 2011 or whatever. but you didn't see it. We saw increased volatility, I'd say. I think you saw probably more 20% corrections, like in 2011, kind of 2015, 2018, those kind of things. But obviously we haven't seen another 2008 since then. And so, my guess is that, we either just kind of keep grinding higher, or, maybe we see some chop. A lot of times you see that in kind of like the second year of a bull market. You see a lot, more kind of sideways movement than what you're used to. But yeah, nothing suggesting that there's got to be a pullback just because it's been a while. So,
yeah. So to put some of those numbers into some perspective in looking at the data, in the 1930s, that decade, there was 33 10% pullbacks during the 30s.
Right.
So you were getting about 3 every year on average back in the 30s. The next decade that had the highest number after that was the decade of the 2000s, where you had 11. And so the decade of the 2000s was very volatile, nowhere near the 30s, but that is the highest number. That's the only other decade other than the 30s that saw 10 or more 10% pullbacks in the market. And that was the decade, the 2000s, although obviously you had 2008, right there in the middle of all of that. But that's also the decade that was dubbed the lost decade for investors, because the S&P 500 had 10% pullbacks, had 4 20% movements, 2 up, 2 down during that decade, but it basically finished at almost slightly lower, but almost the exact same level that it started with. So the S&P 500, the average investor, really didn't make any headway in that decade, but there was a lot of opportunities underneath the surface, and small cap U.S. equities did well, commodities did really well, emerging markets, international, developed, all of those areas produced positive returns in that market environment, where the S&P 500 basically was just flat. So, that was an interesting decade. In the 2010s, there was only 6 though. So while the data says there's about 1 per year, the reality is, we can go many years in between seeing those 10% pullbacks in the market. So just, something to keep in mind and interesting to note there.
And one interesting thing I was just going to hop in and say with the 2000s decade is, you had 11 in that decade, but interestingly, in that middle period, so like kind of in between the tech crash in 2008, you didn't have one. Basically 2003 to 2007, you had a 4-year period where it just kind of grinded higher. I wouldn't say it was like a massive bull market or anything, but it was a good bull market. But then 2008 just, obviously wiped away all those gains. So, again, even in the middle of a bear market, you can have a long stretch, where so interesting stuff.
Yeah, it is always interesting to look at the data and look at the historical averages, and no 2 markets are exactly alike, and that's certainly something that we'll continue to see. Things are certainly different now than they were in the 2000s, and very, very different than they were in the 30s. But it is, I think, very useful just to provide some perspective in the market and looking back at the historical data, and understanding kind of where we've come from to understand where we may go from here. So, with that said, Chuck, it's always great to have conversations. You and I could probably sit here for hours and just talk about, the historical market data and what happened and all that kind of good stuff. But we'll wrap it from here. As always, we appreciate you joining us for these podcasts and these discussions this week. Thank you for taking time to listen to us. If there's a topic or anything you would like to hear us discuss on these podcasts, please reach out to us and let us know. You can email dwa@dorseywright.com, or you can give us a call, 804-320-8511. So, Chuck, thanks for joining us this week for the discussion. Thank you all for tuning in, and we look forward to talking to you next week.